If you're a pensioner or planning to retire soon, I need you to pay very close attention to what I'm about to tell you. The 2025 budget has just dropped a bombshell on retirement savings, and the average pensioner could be facing an eye-watering £1,600 in additional tax costs. Yes, you heard that right. £1,600. That's money that should be funding your holidays, your hobbies, and your comfortable retirement. Instead, it's going straight to the tax man. I'm going to break down exactly how these 6 new tax changes will hit your pocket, and more importantly, what you can do about it. Stick with me until the end because I'll share some crucial strategies that could help you protect your hard-earned savings. Let's dive in. Welcome back to Smart Pension UK, where we cut through the jargon and give you straight-talking advice about protecting your retirement. If you're new here, make sure you hit that subscribe button and ring the notification bell so you don't miss any of our money-saving tips. Right, let's get into this because what's happening to pensioners right now is nothing short of a full-scale assault on retirement income. The government has just unveiled what they're calling necessary fiscal measures, but for millions of pensioners across the UK, these changes represent a devastating blow to their financial security. We're not talking about minor adjustments here. We're talking about a coordinated series of tax changes that, when combined, could strip away over £1,600 from the average pensioner's annual income. That's more than a month's state pension for many people, simply vanished into thin air. So what exactly are these 6 tax changes, and how do they add up to such a staggering amount? Let me walk you through each one, and I promise you'll understand exactly how your pocket is being picked. The first change is the freeze on income tax thresholds, and this is perhaps the most insidious because it's a stealth tax that many people don't immediately notice. The personal allowance remains frozen at £12,570, and the basic rate threshold stays at £50,270. Now, you might be thinking, well, if the thresholds aren't changing, how am I losing money? Here's the kicker. While these thresholds are frozen solid, your pension income probably isn't. If you're receiving the state pension, it typically increases each year under the triple lock. Private pensions often have some form of escalation built in as well. What this means is that more and more of your income gets dragged into higher tax bands without the thresholds moving up to compensate. This phenomenon is called fiscal drag, and it's costing the average pensioner around £300 per year. That's £300 that you would have kept in your pocket if the thresholds had risen with inflation like they should have. The second tax hit comes from changes to pension contribution relief, and this one is particularly painful for those still working part-time or planning to continue building their pension pot. The government has reduced the annual allowance for pension contributions from £60,000 down to £40,000. Now, I know what some of you are thinking. I'm not contributing anywhere near £40,000 a year, so this doesn't affect me. But here's where it gets complicated. This reduction impacts how much you can save tax efficiently, and it also affects something called carry forward, which allows you to use unused allowances from previous years. For higher earners who are still contributing to pensions, this change alone can result in a tax penalty of several £100s. But even for modest savers, the reduced allowance means less flexibility and potentially higher lifetime tax bills. We're estimating this costs the average affected pensioner around £200 annually. The third change targets pensioners who have income from multiple sources, and this is where things get really sneaky. The government has adjusted the way the personal allowance is withdrawn for higher earners. For every £2 you earn above £100,000, you lose £1 of your personal allowance. What this creates is an effective tax rate of 60% on income between £100,000 and £125,000. Now, many pensioners with decent private pensions, rental income, or savings find themselves caught in this trap. You might have worked hard all your life, saved diligently, and now you're being penalized for it. This withdrawal of the personal allowance is costing some pensioners up to £350 more in tax each year compared to previous arrangements. The fourth tax change involves dividend taxation, and this hits pensioners who hold investments outside of ISAs particularly hard. The dividend allowance has been slashed from £2,000 down to just £500. If you're like many retirees who rely on dividends from shares to supplement your pension income, you're now paying tax on an additional £1,500 of dividend income. At the basic rate, that's £262.50 in extra tax. At the higher rate, it's £506.25. For our average calculation, we're looking at around £300 in additional tax for typical pensioners with modest investment portfolios. This is money that used to come to you tax-free, helping you maintain your standard of living in retirement. The fifth blow comes from changes to capital gains tax, and while this might not hit you every year, when it does, it hits hard. The capital gains tax allowance has been cut from £12,300 to just £6,000, and there are rumors it could drop even further. This matters enormously if you're selling assets to fund your retirement, downsizing your property portfolio, or cashing in investments to cover care costs. Let's say you sell some shares or a rental property. You're now paying capital gains tax on an additional £6,300 of gains. At 20%, that's £1,260 in extra tax. Even spread over several years, this represents a significant additional burden. We're factoring in around £250 annually for the average pensioner who periodically realizes capital gains. And here comes the sixth and perhaps most controversial change. The government has tightened the rules around pension tax-free lump sums and the lifetime allowance. While they've technically abolished the lifetime allowance, they've replaced it with new restrictions that actually limit how much you can take tax-free. The lump sum allowance has been capped at £268,275. For many pensioners with substantial pension pots built up over decades of saving, this means more of your pension withdrawals are now taxable. Additionally, the rules around taking money from pension pots have become more restrictive, with higher tax charges for those who want to access their money flexibly. This is costing affected pensioners around £200 per year on average, though for some with larger pots, the impact is far greater. Now let's add this all up. £300 from fiscal drag, £200 from reduced pension allowances, £350 from personal allowance withdrawal, £300 from dividend tax increases, £250 from capital gains changes, and £200 from pension lump sum restrictions. That gives us a total of £1,600 in additional tax costs, hitting the average pensioner each year. But here's what really gets me. These aren't one-off charges. These are annual costs that will compound year after year. Over a typical 20-year retirement, we're talking about £32,000 in extra taxes. That's a small fortune that could have funded dream holidays, helped your grandchildren, or simply given you the financial security and peace of mind you deserve after a lifetime of work. The government will tell you these changes are necessary to balance the books, to fund public services, to ensure fiscal responsibility. But let's be honest about what's really happening here. Pensioners are being targeted because they're seen as a soft touch. You've already saved your money. You can't easily change your circumstances. And politically, the government believes they can get away with it because these changes are complicated enough that many people won't realize they're being hit until it's too late. What makes this even more frustrating is that many of you planned your retirement based on the tax rules that existed when you were saving. You made decisions about how much to contribute, where to invest, and when to retire based on certain assumptions about how your money would be taxed. Now the goalposts have been moved, and there's precious little you can do about it after the fact. So what can you do to protect yourself? First, if you're still working or have any earned income, maximize your ISA contributions. The £20,000 ISA allowance is one of the few tax breaks that hasn't been slashed, and money in ISAs grows completely tax-free. You pay no income tax, no capital gains tax, and no dividend tax on ISA investments. This is your tax shelter, and you need to use it. Second, consider your pension withdrawal strategy very carefully. If these new rules mean you'll pay more tax on pension income, it might make sense to adjust when and how you withdraw money. Sometimes taking less in one year and more in another can keep you in lower tax bands and save you thousands. Speak to a financial advisor about creating a tax-efficient withdrawal plan. Third, If you have investments outside ISAs that are generating dividends or capital gains, think about restructuring. Can you move assets into your spouse's name if they're in a lower tax bracket? Can you time the sale of assets to spread capital gains over multiple tax years? Can you use capital losses to offset gains? These strategies can save you hundreds or even thousands in tax. Fourth, don't overlook pension carry-forward rules, even though the allowances have been reduced. If you have unused allowance from previous years and you're still working, you might be able to make large contributions that still get tax relief, potentially saving you 40% or even 45% in tax on that money. Fifth, stay informed and plan ahead. These tax rules will likely change again, and probably not in your favor. By staying on top of the changes and understanding how they affect you personally, you can make proactive decisions rather than reactive ones. That's what this channel is all about, giving you the information you need to stay ahead of the game. Look, I'm not going to sugarcoat this. What's happening to pensioners right now is deeply unfair. You played by the rules, you saved for your retirement, you did everything you were supposed to do, and now you're being penalized for it. The £1,600 that's being taken from you each year represents real money that would make a real difference to your quality of life. It's dinners out with family. It's heating your home without worry. It's the financial security you earned through decades of hard work. But here's the thing. While we can't change government policy by ourselves, we can control how we respond to it. We can be smart about our finances. We can use every legal tax break available to us. We can make informed decisions that minimize the damage, and we can make sure we're not leaving money on the table through poor planning or lack of knowledge. That brings us to the end of today's video, and I know this has been a heavy topic. £1,600 is a lot of money to lose each year, and the fact that it's happening through 6 different stealth taxes makes it even harder to stomach. But knowledge is power, and now you understand exactly how your retirement income is being eroded. You can take steps to fight back. If you found this video helpful, please give it a thumbs up. It really helps us reach more pensioners who need this information. And if you haven't already, subscribe to Smart Pension UK and hit that notification bell. We're here every week with practical, no-nonsense advice to help you protect your retirement savings and make the most of your pension. Drop a comment below and let me know how these tax changes are affecting you personally. Are you facing an even bigger hit than £1,600? Have you found strategies that are helping you reduce your tax bill? I read every comment, and your experiences help other viewers understand they're not alone in facing these challenges. Remember, your retirement is precious. You worked hard for it, and you deserve to enjoy it without the taxman taking more than their fair share. Stay informed, stay proactive, and keep fighting for every pound of your hard-earned money. Until next time, this is Smart Pension UK, helping you secure the retirement you deserve. Take care, and I'll see you in the next video.